Hi, my name's Charles Elastic. I'm the Managing Director of the Blue Bond Group. We are a specialist firm of inheritance tax planners and financial planners. We have over 40 staff and 20 years of experience helping clients solve their IHT problems. So we offer estate planning advice, legal advice, tax planning, accountancy services and regulated independent financial advisors, all working under one roof. So your plan is built by professionals who all collaborate together to produce a fully integrated plan tailor-made to meet your particular solution. Now, you're about to watch one of our educational videos to help you understand our areas of expertise. To keep things efficient, we are using an avatar, but every word has been personally checked by me and based on 20 years of real-world experience. So watch the video and let's see how we can help. Thanks, bye for now. Let's get started.
Hello and welcome. Today, we're tackling a topic that many people find daunting but is absolutely crucial for safeguarding your family's future. The goal for many is to pass on their wealth with as little IHT as possible, ideally none. And while that sounds ambitious, with the right strategies, it's far more achievable than you might think. Today, we're going to demystify two powerful tools in your inheritance tax planning arsenal: the flexible reversionary trust and the family investment company. Inheritance tax in the UK can be a significant drain on your estate, currently levied at 40% on assets above certain thresholds. Without proper planning, a substantial portion of your hard-earned wealth could go to the taxman rather than your loved ones. But this isn't about avoiding tax illegally. It's about smart, legal planning that allows you to control where your wealth goes and ensure your legacy is preserved. Let's start with the flexible reversionary trust. This is a powerful, yet often misunderstood, tool. And here are the pros. IHT efficiency. A key advantage is its ability to remove assets from your estate for IHT purposes after a certain period, typically 7 years. The assets gifted into the trust are no longer considered part of your estate. Control. Unlike some other trusts, with a flexible reversionary trust, the settlor, that's you, can potentially regain access to all the capital and growth of the investment over a 7-year period, giving you a degree of flexibility should your circumstances change. This reversionary aspect is what makes it unique. Income stream. It can be structured to provide you with an income stream during your lifetime, while still removing the capital from your estate for IHT. Protection. Assets held in a trust can be protected from future claims, such as divorce or bankruptcy of beneficiaries. Now, let's look at the cons. Irrevocable gift. While you might get capital back, the initial gift into the trust is generally irrevocable. This means you cannot get it all back at once. You need to be comfortable with this. 7-year rule. The assets are only fully outside your estate for IHT after 7 years. If you pass away within this period, an IHT charge may apply. Complexity. Setting up and managing trusts can be complex and requires professional advice to ensure compliance with trust law and tax regulations. There are ongoing administrative responsibilities. These are largely covered by the trust providers, meaning you have very little paperwork to deal with. Loss of full control. Even with the reversionary element, you don't have absolute, unfettered access to the capital as you would if it remained in your name. You can, however, assign all the assets to your beneficiaries at any time, but they cannot gift the money back to you. Now, let's turn our attention to family investment companies, or FICs. These have gained significant traction as a sophisticated wealth planning vehicle. And the pros are: succession planning and control. FICs offer an exceptional level of control over family wealth across generations. You, as the founder, can retain control over the company's assets and dictate how income and capital are distributed to family members. IHT mitigation. Shares in the FIC can be gifted to family members either immediately or over time, often using annual IHT exemptions, thereby gradually reducing the value of your personal estate for IHT purposes. The growth in the FIC's value after the shares are gifted also falls outside your estate. Flexibility in distributions. Profits can be distributed as dividends to shareholders, which can be tax efficient depending on the recipient's tax band. Asset protection. Assets held within an FIC are generally protected from personal liabilities, such as divorce or bankruptcy of individual family members. Tax efficiency on investments. FICs pay corporation tax on their profits, which can be lower than higher rates of income tax for individuals. And the cons are complexity and cost. Setting up and maintaining an FIC is significantly more complex and expensive than a trust. There are ongoing compliance costs, company secretarial duties, and accounting requirements. These are the same as any other limited company. Corporation tax. While potentially lower than income tax, the company itself is subject to corporation tax on its profits, and then shareholders pay tax on dividends received, though this can be managed. Potential for disputes. Without clear governance, FICs can, in rare cases, lead to family disputes if roles, responsibilities, and distribution policies aren't clearly defined. So, which option is best for your specific circumstances? There's no one-size-fits-all answer. It really depends on several factors. For your primary objectives, is it pure IHT mitigation, control, asset protection, or a combination? The value and nature of your assets. Are you dealing with liquid assets, property, or business interests? For your family dynamics, how involved do you want your family to be in wealth management? For your tolerance for complexity and cost, are you prepared for the ongoing administration and expenses? Your desired level of control, how much control do you want to retain over your wealth? Both flexible reversionary trusts and family investment companies are powerful tools for inheritance tax planning in the UK. They offer different advantages and disadvantages. The key is understanding these nuances and aligning them with your personal and family goals. In most cases, clients do both, using their trust allowances in full every 7 years and also using an FIC at the same time for the many advantages they offer. Both plans are very useful vehicles for wealthy people to resolve their IHT problems. Inheritance tax planning isn't something to put off. The sooner you start, the more options you have and the more effective your planning can be. While this video provides a valuable overview, your situation is unique, and tailored advice is essential. That's why I'd like to invite you to sign up for our free upcoming webinar, Inheritance Tax Planning in the UK, Your Questions Answered. This webinar will delve deeper into these strategies and many others, giving you actionable insights and the opportunity to ask your specific questions to our expert team. You can find the link to register for the webinar in the description below. Don't miss this opportunity to take control of your financial legacy. And if you found this video helpful, please give it a thumbs up, share it with anyone who might benefit, and subscribe to the Blue Bond YouTube channel to stay up to date with our latest insightful videos on financial planning and wealth management. Thank you for watching, and we look forward to helping you secure your family's future.